Let's go over why Side A coverage on a D&O policy is so important. First off, what is Side A coverage? Side A coverage, rather than Side B or C coverage, refers to coverage for directors and officers that have not been indemnified by their organization. While it's common practice and important for an organization to indemnify the directors and officers sitting on its board, it isn't always possible. It could be that the company is facing insolvency and doesn't have the resources to indemnify the individual directors, or it could be that they're legally not allowed to do so. So let's go through an example. Imagine Sally has agreed to sit on the board of a privately held energy company. The company is struggling. Sally and the other directors do what they can to revitalize the struggling company. The company has a number of assets, so in order to get some quick cash, the directors agreed to sell many of these. Given their financial position, the directors weren't as bothered about getting market value for their assets, as they needed cash very quickly, so they accepted immediate offers. A few months after the asset sales, with the company still struggling, a lawsuit was filed against Sally and the other directors. The lawsuit alleged that Sally and the directors were liable for disposing of company assets under their market value while not having the ability to pay their creditors. Now, Sally has an indemnity agreement with her organization, so normally her organization would hold her harmless for this claim and pay the defense and damages. This would be what's referred to in the D&O world as Side B coverage. Sadly, this was not the case for Sally. The company was not able to indemnify her and the other directors, as they had recently filed for creditor protection. Because Sally was named as a director on the lawsuit, she could be on the hook for the costs. If Sally's organization had an insurance policy in place that provided Side A coverage, Sally would be off the hook. But what if the D&O policy in place had a $1 million limit that had already been exhausted for other bankruptcy-related claims, or an employment liability claim? This is where an additional limit for Side A coverage on top of the general policy limit would be most helpful. An additional $1 million limit for Side A coverage is a feature in some policies. However, you can apply for additional coverage under a separate policy. So you can see how Side A coverage can be a wise investment for directors and the protection of their personal assets. If you enjoyed the video, like it, share it, and tell people about it.